Welcome back to Strongman Personal Finance. Welcome back, everybody. My name is Christopher Belly. I'm a certified CPA accountant. I'm a long-term boglehead investor. I'm author of the book Stop Being a Broke Loser. It's on Amazon, and I'm probably a freaking disaster right now. Well, I'm always kind of a disaster. But now I have two kids. One is 11 months old and teething, and one is like 4 days old, and basically just being a newborn. So I'm not getting a lot of opportunities to come onto YouTube, but I'm trying, okay? Please forgive me. So we're going to talk about Dropbox Inc., also known as FARTBOX. And I truly believe this stock is not a buy right now. Now, I've looked at the financials, and we're going to look at them together. And there's some interesting things going on, and I'm going to show you why they're interesting. And in my humble opinion, I think this stock is dangerous for several reasons. Number one, because it rhymes with FARTBOX. Just kidding. Now, Dropbox is a cloud storage provider. You can go on there, you can upload your documents, and I actually use the free version. I have a ton of stuff on there. But am I willing to pay for it? Maybe. Now, they also have a professional version where you can get some e-signature editions, which is very convenient. For example, whenever I decide to start launching my tax business, I'm going to have people e-sign stuff, okay? I'm going to keep stuff as simple as possible, like engagement letters, stuff like that. And if I have Dropbox and I'm paying a small monthly fee, it's pretty convenient to be able to store client documents securely, and they have a lot of storage available. And you can have your clients sign stuff. Very important that they do that. So I'm a fan of this site, and I think it's convenient. But the number one risk with this company is competition. There's freaking cloud storage everywhere. What is unique about Dropbox? Now, if you just go and Google cloud storage, there's all sorts of different options. You got Google Cloud, you got Amazon, you got freaking everything. You got Dropbox, you got Box. I mean, there's crap everywhere. You go to PC Mag, let's see what they have. Microsoft OneDrive, iDrive, Google Drive, Dropbox, Spark, Spider Oak, Box, Apple there's freaking crap everywhere. It's nuts. So what distinguishes Dropbox from everything else? Really not that much. And a lot of these other sites, these other cloud storage providers have way more cloud. I mean, Google, Microsoft, Amazon, AWS, that's a lot of cloud, okay? So Dropbox is in a very competitive market, and they're a very small fry. Now, if we go and look at their recent stock performance, and I'm actually up today. Baba Mayaba, Baba Mayaba. I'm still down massively, but whatever. Dropbox. The stock hasn't really performed that well. Now, I don't judge a stock based on its performance. It's really, past performance doesn't matter. It's all about what is the price of the company today and what is its future potential. Now, Dropbox IPO'd in 2018 at $29, and now it's $20. So if you bought it since the IPO, you got a negative return. Market cap of $7.87 billion, price to earnings of 22. Not super high, at least compared to the S&P 500, but it's pretty rich. Now, the second thing that really concerned me about Dropbox is you see they've had a lot of pretty explosive growth in revenue, okay? They had $603 million of revenue in 2015, and now they have $2.15 billion. That's pretty significant revenue growth. However, remember when we all locked down in 2020 and everybody had to switch to online and distance, remote work and stuff like that? Well, you'd imagine Dropbox's revenue would explode during that time period, but it hasn't. It's actually dropped. I mean, well, the revenue's increased, but the growth rate has continued to decline. So when you try to value this company, which I'm really not even going to try to do, and I'll show you why, you really can't use high growth assumptions. And you compare that to stuff like AWS, I mean, it's growing way, 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 way faster. So we go down, we look at some basic metrics. So they have growing revenue, that's good. Gross profit is pretty high. They have a gross profit margin of 79, 78, 75, 70. So they're actually increasing their gross profit. They also have free cash flow. Very interesting. However, look at the profit margin. So they finally turned a profit in 2021. So they've had positive free cash flow. Look at their free cash flow margins. 26, 23, 25, 32. Positive free cash flow since 2016, but their profit margin has been negative all the way until 2021. That's very, very interesting. Now, whenever you see a discrepancy like this, it's usually because they have a lot of non-cash expenses. On the statement of cash flows, non-cash expenses are added back. So the question is, what are these non-cash expenses? Let's go look. So right off the bat, you're going to have pretty big depreciation, amortization for any business. Every business basically has depreciation and amortization. That just represents capital assets or intangible assets that you have bought and you have to expense them over their useful life. Makes sense, so I'm not concerned about that. But we go down and we see, oh my God, look at this. Share-based compensation. What does that mean? Well, that means they're giving their employees stocks. And what does that mean? You're getting diluted. So basically, the reason this company has positive free cash flow is because they're not paying their employees in cash. They're paying them in shares. Is that a good thing for the employees? Maybe. Is it a good thing for you as an investor? No. So let's see how the shares have changed. Now, an interesting thing that Dropbox is doing is they're issuing their employee shares, but they're also buying back shares. They bought back $1 billion of shares in 2021. It's a very weird thing they're doing because they're paying their employees in shares, so they're diluting, and then they're buying it back. And even freakier, and I noticed this, is they issued debt. They issued $989 million of debt to buy back shares. What? Why? Why are you going into debt to buy back shares? And then at the top here, you're freaking diluting the shareholders via stock-based compensation. That's very freaky to me. I don't like the concept of a company borrowing money, especially with rising rates, and especially when you're GAAP negative, your income is negative on an accrual basis of accounting, and you're using that to buy back shares. That's very, very odd. So now they have at a minimum, $989 billion of debt, or $1 million of debt, now just to buy back shares. So when you look at it, you're like, oh my God, free cash flow. So amazing. It's growing so fast. Yeah, because they're paying their employees with freaking shares. Look at some ratios. So their market cap, $7.8 billion. PE ratio, 22. Price to sales, 3. Price to free cash flow, 10. It's pretty cheap, right? EVD, EBITDA, let's see. Where's the debt to free cash flow? So as of right now, their debt isn't too unreasonable. They have, basically, it's going to take them 3.24 years. If they took all of their free cash flow and used that to buy back debt, pay off debt, they could do that in 3.24 years. So it's not freaking crazy. But at the end of the day, I don't like the fact that they're borrowing money to buy back shares. I think that's freaking stupid. Now, another thing I noticed, and I was scanning their 10K, which is their annual financial report, and they are using Amazon Web Services to help provide storage. They're using a competitor to help provide storage. So here they say more than 90% of our users' data is stored on our own custom-built infrastructure, blah, 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 blah. And they have centers in California, Oregon, Texas, and Virginia. We also utilize Amazon Web Services for the remainder of our user storage needs. You're using a competitor to help provide your service. And is that number going to grow? Maybe. And the more they use a competitor's web hosting, the more risky this company is. So that right there, it's like, what? Why are you doing this? Okay. Now, one thing that I do like about Dropbox that's positive, we built a thriving global business with 16.79 million users, and they have a highly diversified user base. No customer accounts for more than 1% of their revenue. Now, Dropbox provides services mostly to small businesses. So a guy like me, let's say I start my tax business, or I have a YouTube channel, that's a business. Or let's say I did tutoring outside of Wyzan. If I wanted to store client documents, I would probably look into Dropbox, to be perfectly honest. I mean, look at these plans here. they have for individuals. So let's say I don't need somebody to sign something. $9.99 a month, and you get 2 gigabytes of storage. That's a lot of freaking storage. Or 2,000 gigabytes. That's what, 2 terabytes, something like that, roughly. And then if you want the professional version, where you can have people sign documents and get 3,000 gigabytes of cloud storage, $25 a month. That's really not that bad. So I don't hate Dropbox, but I'm not a fan of it. They're losing money on a GAAP basis of accounting, and that's because they're freaking paying with share-based compensation. And they finally had positive net income. But the question is that going to be sustainable? Because I see R&D keeps going up, selling and general administrative expenses. They've cut those a little bit, but they only just became profitable. And they're issuing debt to buy back shares. I don't like that. So I would be very careful with this company. It's very freakish to have such a negative profit margin and have such a high amount of free cash flow. And they're using that free cash flow for, what are they even using it for? I mean, okay, buy back shares, I guess that's okay if you think the company's undervalued. But I don't know. I'm not a fan. So I know Jerry Financial Education likes this, but when you think of the competitive landscape and the fact that they're using a competitor's servers and that may continue to grow, not a big fan. So that's my thoughts on Dropbox. I think it'll have you selling your FARTBOX in retirement. But from a user perspective, I actually like it. And when I start my business eventually, I'm probably going to look into Dropbox to have people sign stuff. So that's kind of my thoughts. You can do your own analysis, but until they cut down to that share-based compensation and they stop issuing debt to buy back shares, I'm out. Talk to you later.